the EGROW webinar series, which we do every Friday. As I just mentioned, this is the first time we are doing in this slot. We have generally done it post-lunch, and most of the time we have had between 4 and 7. Very rarely 9 and 10 if our speaker is from Los Angeles or Stanford or San Francisco. And this is the first time we have moved it 12 to 1. And we are hoping that we get good participation. In general, the participation has been around 80 people, ranges between 80 and 150. But in general, about 80. We get participation from 4 different countries, most of the time, neighboring countries, Bangladesh, Sri Lanka, Bhutan, Nepal. So I'm hoping that in this new slot, we'll also get that. EGROW Foundation is a research-based think tank, believe in policy-oriented research and research-based policy advice to the stakeholders, government, and other institutions who seek our research support. We have been here for nearly 5 years now. And since COVID, we started this webinar series. We have completed about 200 webinars so far. We do it every Friday. When we started, because we're a research-based policy think tank, we said we would like to bring in researchers and scholars, academicians and practitioners across the world. We have been very fortunate. The blend that we have achieved is extremely beautiful. We have had Nobel laureates on this webinar series. Under the G20 presidency, we for Task Force 5 did series of lectures, 10 of them on international economic order. We have already done for women empowerment, again, a G20 agenda. We have already done 10 and 5 are in the wait list, which we'll be doing. The EGROW webinar series is really a calendar item. We are booked till end of March. So we feel very fortunate that we have been able to bring this blend of foreigners and Indian scholars, sometimes on global issues and most of the time on Indian policy issues. And that is how we are serving the policy making within the country. There are very, very important things that are happening globally, full of uncertainty. And we suddenly stumbled upon a beautiful report, which has been authored, Winning in Uncertain Times by BCG. And therefore, we thought right now, before the budget cycle starts and the monetary policy announcement, we would like to hear about this report. To discuss this report, we have the author himself, Mr. Hardik Shah, Managing Director and Partner in BCG's Bombay office. And he's being supported by Deep Narayan Mukherjee, who's a risk management professional. Both of them, Mr. Hardik Shah and Mr. Deep Mukherjee, bring very rich experience, which is reflected in the report. To chair this important discussion, I could think none else but Professor Jayadev, my dear colleague at IIM Bangalore. I'm very impressed with the type of work he does. He also engages intensely with the policymakers. He is on the board of a commercial bank, understands the financial world like the back of his hand. Right now, he's of course the Dean Administration at IIM Bangalore, but he's mainly the faculty of Finance and Accounting. And his professional services are in areas like Basel Accord, banking and risk management for several banks. And therefore, we thought the best person to chair this report and discussion would be Professor Jayadev. As a discussant, we have invited another good friend of mine, Dr. K Gupta. He has about 45 years of corporate experience with various public and private sector organizations in the domain of finance, valuation, costing, internal audit, sustainability. And currently, he is the Managing Director of Registered Valuers Organization of the Institute of Cost Accountants of India. He is also the Chief Executive Officer of ICMAI, Social Auditors Organization, and Chief Operating Officer of ICMAI International ADR Chamber. With this, I hand over the session to Professor Jayadev to conduct the proceedings further.
Good afternoon to all, and thanks to Professor Charan Singh for giving me this opportunity to participate in this important discussion. And really, it is very interesting to go through the report prepared by BCG in collaboration with FICCI on with reference to banking sector, because banking sector has been doing very well in the last couple of months. It has achieved a good amount of stability, financial stability, and a lot of NPS have been reduced. Whatever the stress is there, stress has been reduced, and many banks have started adopting new business models of digital lending and digital banking, and really banking in India is undergoing a lot of change. In this context, it is good to discuss about what are the challenges and what are more opportunities the banks are having. And we have Mr. Hardik Shah. And welcome, Hardik Shah, for this discussion. And I'm happy that you have given time for this purpose. And certainly the discussion is currently being participated by a couple of members, but as Dr. Charan Singh has pointed out, many more are going to watch it online afterwards. That would be a great value addition. So we can, without taking much time, Professor Gupta, Dr. Gupta is also here. Welcome, Dr. Gupta. And without taking much time, I leave the podium for Mr. Hardik Shah to make a presentation, and he can invite whenever he is comfortable with his colleague, Mr. Deep Mukherjee, and both of them can make a presentation, and subsequently we can have discussion on this one. Thank you.
Thank you, sir. Thank you very much, and good afternoon to everyone. It is an honor and privilege to be part of this, extremely profound, platform and webinar series. What I would like to do is, along with Deep, for the next 25 to 30 minutes, present a few insights from the report that we've published along with FICCI and IBA, and then we'll open up for discussion for the next 25, 30 minutes so that we get a wide range of perspectives on what's happening in the banking industry. So I'll just put up the presentation just a second. Okay. Is it audible?
Yes.
Yeah. Okay.
Yeah, it is visible, audible.
Perfect. All right.
Yeah.
Deep, you want to kick us off?
Sure. You're projecting?
Yes, it's up.
Okay, I think I'm unable to. Just give me a moment. I'll just give me a second. Okay, thanks. I can see it. So, can you go to the first slide? Yeah, thanks. Yeah, it's just visible. So, what we have done here is, it's part of a global study that we are undertaking. And here we are taking some popular matrices to start off with: ROE, ROA, and we are taking all the way from 2006 to recently. What is sacrosanct with 2006? We wanted to get some idea of how how the returns were prior to 2008-9 period, when regulations were really ramped up with the post GFC regulatory ramp up in terms of capital, etc. So the period of analysis 2006 to 2023, a good 17 years. And here we find that, yes, the ROE and ROA, just to be mindful, they are not necessarily measures, and there are pros and cons about it. But ROE and ROA in India has significantly bounced back from the dip of 2018. Now, one may argue that ROE is still lesser than 2006 level, and ROA is barely at 2006-7 level. But there's a major impact that has happened post 2008, where because of higher regulatory actions globally, there has been a damping down of returns, as you can very well see that the global returns has fallen by, in terms of ROE measures, well over 400 basis points.
In India, it has fallen in the terms of ROE, but just about 250 basis points. If one looks at ROA, incidentally, India is currently in 2023 is up by 10 basis points over a 15 year compared to 15 years back. Globally, it has structurally fallen. Price to book value, price being sort of sensitive to market sentiments, there has been sort of several swings. However, price to book value has come down in India by 18% from the pre-global financial crisis levels. Globally, price to book value for global banks as a setup has come down by well over 60%. Now this is major, and one message one can take it that despite regulatory strictures, everything, one beacon of hope for in bank remains Indian banking, and therefore we are saying the North Star. On the gross NPA side, all of us are quite aware we have turned around the corner. We are improving, are at a decadal best. If you go to the next slide, please. So, and there's a bit of a transition. Yeah. So why we call India the North Star of banking? Price value. If you look at and this takes various regions of the world, and we pick up from public sources banks which represent 80% of that specific market. And here you see that as a group, Northeast Asia, Europe, their price to book value is actually significantly below 1. I mean, the implication, while it's quite clear to us, just so that all of us are on the same page, it's like if you have $100 of your assets, the market is not even thinking that you are worth $100. So it assumes either two things, either next to nothing growth in earnings or severely deteriorated assets which are not captured in the book. As one moves to North America, things thankfully become better with the price to book value ratio above 1. But what really stands out is India's price to book value ratio, where we consider 80% of Indian banking assets, and this is again supportive of the fact why we are calling it the North Star. It's clearly an outlier on the positive side. If we go to the next slide, Hardik. So this while on an average things looks wonderful, but we are growing. We need a very strong banking system. So we really can't rest on our laurels. So when we sort of disaggregate the price to book value, and here how do you read it? The y-axis is the price to book value. Each of the individual skyscrapers, segregated by the vertical white line, they represent one bank, and on the x-axis is the aggregation of their assets. The horizontal line is the price to book value of 1. Now, there are bulk of Indian banking thankfully has a price to book value of 1. There are a small less than 25% of the banks by total assets where the price to book value is well over 2. However, there is a spot of bother. 45% of the banks accounting for 40% of advances. That's I'll request you to focus on the right hand side. That's where they are the, even now as of 2023, when we had possibly the best earnings in close to 15 years. There are banks in the system where the price to book value ratio is 1, which means either the market doesn't believe its asset is 100 rupees, it should be less, or they are not assigning any meaningful earnings growth to them. So this is something that needs to be addressed. While we have significant strength as a basis, but we can't sort of keep this unaddressed. If you go to the next slide. So we have taken a classic measure. I mean, ROA, ROE, they are not adjusted for risk. You can have a bank with a fantastic ROA, but where the equity consumption may be too high. And here we actually have taken for top 20 banks in India with last at least 10 years of data. The expected loss is, of course, the long-term average mean, if you may please. So maximum observed PD is empirically observed. And what we have taken is we have used certain statistical techniques, good old-fashioned econometric techniques called extreme value theories. We have fitted the curve for India. It takes, for those who are into statistics, some of the distributions in the Fisher-Tibet series of the distributions, and we estimate rather what would be 1 in 1,000 odds. What will be 1 in 1,000 odds loss look like, which in Basel parlance. I think this, which in Basel parlance is of 1 in 1,000-year loss severity. We have calculated that, and the amount of capital required to cover up that loss is, of course, economic capital. We calculate the economic capital for each of the banks using this 10-year data. Now, again, we have ROE. We can have return on regulatory capital. We can have return on economic capital. Now, as a measure of shareholder value, economic profit is the excess return of ROEC over your cost of equity. You can have a cost of equity of 15%. If your ROE is 12% or 15%, it doesn't directly add to shareholder value. If you're tracking shareholder value, your ROEC should be higher than your cost of equity, and that's economic profit. And what we have done subsequently is, again, we have gone into empirical analysis to test this hypothesis that among the matrices ROA, ROE, and EP, which one is the better one? And this analysis, as we are showing, suggests, I think the screen is taking time to shift. Yeah. So here you see on the x-axis is ROA, a measure which almost every bank uses for its strategy planning. ROE is a combination that market uses in its discussions to evaluate company. Now we think that things can be better because we don't want to enter into a trap where we are targeting ROA in companies or banks or in their portfolios where the economic capital consumption is very high, which will actually drag down the economic profit, because it is the positive economic profit which adds to shareholder value, and the closest proxy for which is, of course, price to book value. Now, if we just benchmark this and do a regression with all the usual statistical concerns, we find that economic profit across the time period, across the panel, it accounts for 41% of the price to book value, or basically adjusted R square of 41% is explained by the EP alone. The next popular measure, ROA, it does explain price to book value, but only to the extent of an adjusted R square 33%. ROE, we saw if you look at the middle to sensitize companies, markets, regulators to focus on EP along with ROA and try to see which are the portfolios of banks which are adding shareholder value, and if they are not, how can we sort of take the necessary steps and not just get trapped into ROA, ROE. I'll hand it over to Hardik to take us forward.
Thanks, Deep. So the context to this is, and as Deep articulated, I think, three messages or, action points for Indian banks. Number one, the context is that India is a shining star amongst all the banking, markets globally, across emerging markets and developed markets. Our price to book value is better. Our return metrics are better over a long period horizon. But if we de-average it, there is still a certain section of the industry that is not returning the cost of equity. And how do we actually, bring up their capabilities, bring up the, profitability index of it? Our research suggests that there are 5 different imperatives as banks look forward for the next 5-10 years of horizon. And these are the 5 that we've articulated in our, report. Number 1, the future of distribution. And we'll talk about how the different channels of the banking industry and the distribution as it serves the different, customer base and the strata of the Indian, society. What should be the investment looking forward? Second, a lot has been said about the India's, digital public infrastructure, how that actually enables a banking which is, ubiquitous across different, platforms, across different channels, and how should banks actually think about investing in the digital potential. The third thing is, even as banks struggle to, fully harness the power of the digital revolution, there is the Gen AI disruption that will come up in the next couple of years. It's already underway, as we've seen this across global banks. And what should be the new wave of talent? What should be the new wave of looking at different business models and functions within banks? Fourth, climate change is, real. Different economies have taken different pathways. As banks look at a longer term horizon, there is a 2-speed world that they need to look at as they start investing in transition finance and looking at physical risk on the other side. And last, I think the risk management maturity as digital, becomes all pervasive, as the lending becomes, completely, data driven. How should banks improve their maturity on the risk management framework? So if we go into each one of them, I think this is just a snapshot of how Indian banking and the distribution models have evolved over the last, 30 years. Branch banking globally, if you look at across markets, is receding. Number of physical branches, the density of the branches globally is receding across markets. But if we look at India, actually branches continue to evolve. There is a lot of investment in the physical brick and mortar model that banks are still undertaking. But with that, what we're seeing is also a very, very high digital or a low cost distribution model. The BC model has completely transformed in the last 10-15 years, and that will continue to do so. Digital or embedded finance, as banks look at it, becoming distribution points on e-commerce platforms, on ONDC, on fintech, on big tech platforms. What will be the future of banking? And the reality is that banks will have to invest in each of the channels and make sure that all the different products and digital solutions are available across these different channels. And what's powering this is the unique digital infrastructure that we as a country have, right? And if you think about it, a BC, touch point, a Kirana store, in rural, semi-urban, location can become almost a full-fledged bank on the back of the digital public infrastructure that India has. They can do, consent-based, product, selling. They can do completely digital underwriting, completely digital distribution. And it's not restricted to just, payments anymore. Liabilities, assets, lending, insurance and investment products, all of it can be actually distributed through this digital infrastructure. And the cost to serve these customers becomes lower and lower as we go forward. The second, interesting point that we've, looked at is account aggregator, or the, third layer of the, India Open Stack. We've looked at, the adoption rise in the last, 12 to 18 months as we look at on the left-hand side, the different entities that are now coming on board. It's not only banks, there are 40 AMCs, 44 insurers, depositories, CREs, all of that are coming on board now. And as we think about the implications, the lending which used to be earlier or erstwhile completely dominated basis your credit history on bureaus or the banking history that was available on your account activity can change dramatically. People can now look at your micro insurance, your micro SIP penetration, persistency, and banks can start looking at that behavioral data to start lending out to different customers, different NTC segments that were not part of the formal credit, mechanism erstwhile. And this changes dramatically the adoption or the penetration of formal credit across the bottom of the pyramid as we look at it. While the digital disruption is there, one very big and interesting trend that's playing out is generative AI. And if we look at it from a very simplistic way of thinking about it, as now it's called traditional AI, but the predictive AI and the generative AI. We're saying, the left brain or the functions of predictive decision making, all of that are something that will continue to resonate with the traditional AI. Risk management, risk models, fraud detection, all of that will continue to be function. But as we look at the right-hand side, the generative AI will open up a set of capabilities and a set of functions for banks that were erstwhile really cumbersome, dependent on high-cost manpower, and a constraint as people wanted to scale up. And if you just look at one simple example of personalization in banking, right? The biggest bottleneck that used to be, apart from the technology and the analytics behind it, used to be the content creation, just the human content creation in terms of images, in terms of copyright, in terms of media. All of that becomes very, very seamless with the adoption of generative AI technologies. And that's what's important as we look forward. There was a time 10, 15 years back, banks used to ask this fundamental question of what should be the reskilling of the talent that they have, right? Private banks used to ask the question of, how should we go and, hire these talent? Public sector banks used to have this question of how should we reskill this talent? But as we look at, generative AI, another wave of disruption, the question is what will be the roles of, talent in a bank going forward? There will be, different type of talent required, people who will shape the AI models, people who will build these generative AI models, people who will govern these AI models so that we don't have the biases and the inherent risk with the generative AI. And new frontiers will open up. If I just take one example, wealth management that used to be really high cost and used to serve a very small section of the pyramid for banks can now be opened up to a very large segment. Mass wealth can become completely possible within the realms of generative AI. We can have virtual RMs, digital RMs that can actually tailor to this new segment of society. And that is what we are believing in the next 5 years as we go forward. A lot of capabilities, a lot of new business models, a lot of function reinvention will happen as banks start adopting this technology. The one other thing, if we just pivot around, is the impact of climate change. And we've done this research, looking at India's current credit deployment. Almost 50% of the credit deployed today by the banking industry is vulnerable to one or the other form of climate or natural risk, whether it's drought, flood, whatever be it, there is a very real physical risk that exists. Second, as banks think about their current assets, there is a very large transition risk and a financing need that is required to move away. And that number is anywhere between $2 to $2.5 trillion just by 2030. Third, a lot of jobs are expected to, be impacted because of climate change. A lot of jobs will, change in the nature of the reskilling and the upskilling of people required. And given this, what we're saying is there is a two-speed world that banks need to, adopt to as they think about the financed emission or the scope 3 emissions. And what you see on the top is a simple MAC curve for Indian oil and gas industry. It's just an abatement curve by different technologies. The left side of the technologies are ones that are actually cost neutral for banks or, for the industry that they're being deployed in. And there is a real commercial use case in terms of, financing these different technologies. The right side of the curve is actually technologies that are currently unproven, or if they are proven, they are very high cost to deploy. So as banks look at the different assets in their portfolio, they need to look at this, divergence of the different technologies, understand the maturity of these technologies and say, what should be the participation model for us? Should the left-hand side become, bare stakes, table stakes, and they should just go after deploying credit behind this? which means that the frontline RMs, which means the entire, branch distribution need to understand these technologies, need to be upskilled for these technologies, need to understand how to underwrite these different, maturing technologies. But even true is the right side, which is all the future technologies. How should they participate in? Should they create a green bank? Should they create a equity participation model looking at, sovereign funds, PE funds? How should they think about these, participation models? And that's where right now, if you think about it, there is a lot of lack of clarity or, vision for banks as they think about these climate financing models. The one other implication that we've come out as part of the report is if we look at the transition, there's a lot of focus towards the larger corporates, and actually the larger corporates will have all the wherewithal capabilities in terms of managing the transition risk. But 60% of the financing that will go as part of this transition finance will actually be towards these supply chain which are catered by smaller MSMEs. If you just think about a simple example, there is an MSME that is sitting out there in a textile hub in, Gujarat, and then they're actually servicing a larger hospitality chain that has now decided to make their, operations completely eco-friendly. And they will force their supply chain to become, eco-friendly and, reduce their carbon emissions. For these MSMEs, banks will play a very, very critical role in terms of advisory services, in terms of just beyond lending, thinking about how do they help them in terms of the broader ecosystem, certification services, carbon calculators, connecting them with the different OEMs that can help make their operations greener. All of this will become really, really relevant as far as banking industry is concerned, because for the MSMEs, they will have to play this, critical role as they go forward. And the last implication, as we looked at the different banks that participated as part of this, study with us, only about 10% of the banks are leaders when it comes to risk management, framework, which is globally accepted and, best in class with the global benchmarks, which is that they have, models that are quantitative, statistically derived, they have the right risk management framework, the governance setup, the right, CXO positions, created for the different functions. The 90% of the banks in the industry today still have a very, very long way to go if they have to get their maturity, framework right. They need to think about all the, use cases of digital penetration, think about cyber risk, think about the risk that will come through Gen AI in terms of biases, in terms of, copyright infringements, etc. So that is a long way for us to go as far as, risk management is concerned. And why are these 5, imperatives important? One of the things that we looked at, globally, and this is a simple chart that, tracks domestic bank lending to the GDP. It's an indexed number that we've looked at. Banking industries that have been, doing well to support the GDP have an average PB which is greater than 1. If we go back to the, start where Deep talked about the P by B of Indian industry and the de-averaging of it, right? If we have to, support the GDP and the aspirations of the GDP for the next 20, 25 years, the banking industry will have to play a very critical role and they will have to have the right valuations. The other thing that we've also, looked at is if we look at the chart on the left-hand side, what is the share of the domestic credit to the private sector as part of GDP? There's a lot of credit under penetration, but actually the right-hand side of the chart is really important. Indian, economy is still a very, very bank-led economy. The, penetration or the sophistication of the other financial assets is still very, very low compared to the other economies. And hence banks will continue to play a very, very critical role as we think about the 30 trillion ambition of the GDP by 2047. And there are a set of imperatives that the regulators, the industry, all the different stakeholders need to come together and actually make towards making this stronger. So if I just recap the summary and the genesis of our report, we are actually right now the North Star as far as banking industry is concerned. There is a very de-averaged view across the different segments of the banking industry. And there are a set of imperatives that the leaders in the banking industry also need to build and equip themselves. but the laggards also need to get the right set of capabilities and invest in them. I'll just pause and open it up for any thoughts, reflections, and discussion.
Very nicely presented, Deepak Mukherjee as well as Hardik. Very you have highlighted starting with the profitability. I have one or two some questions or dilemmas which are going on with reference to profitability. In the recent past, the banks for the last 2-3 quarters, banks are experiencing low growth in the deposit. The deposit base of the bank is declining. The cost of liabilities is increasing, and NIM is getting reduced. In this context, how do we reach to the level of ROA which you have stated, and is it still a far longer lower goal to reach the level of the ROA which is with benchmark with reference to global banks?
Yeah.
So I think Indian ROAs are actually on an average much better than in global banks already.
Yeah.
Now of course ROA being a function of the asset, when interest rate rises, the ROA tends to sort of flatten out or fall for pure structural reasons. That's the nature of the animal. So now we obviously are not predicting where the interest rates would be, but assuming that interest rate moves up from here on, etc., there may be a flattening for pure structural reasons.
No, but the point is the base is declining, the deposit base is gradually coming down. Many banks are facing the challenge of this retaining or sustaining the deposit accounts because alternate avenues have opened up very quickly and easily. They can the very alternate. So how this is going to affect the cost of liabilities and NIMs of the banks, and whether this is going to be a challenging issue for the next couple of quarters for the banks.
So we honestly haven't deep dived into that specific angle on with respect to India, but the general observation globally has been that wherever the bank rates that the bank offer to the retail depositors, if they are more market linked or move closer to the market, there is a pressure towards reduction of NII, because banks previously had, for lack of a better word, a more close set of customers who may not have been tapping the market in a big way. So it does tends to sort of dampen NII globally. I mean, but in India we haven't specifically deep dived into that question.
So 2 parts to your question. If I just elaborate, I think your point is absolutely valid. I think the cost of deposits is going up. Deposit war is quite real if you look at the banking industry, especially on the CASA side. And as people become more financially aware, you're right. The investments into other forms of financial assets is increasing. So the cost of liabilities will continue to rise. I think the other side of the NII, which is the asset or the lending side, is equally important. There is one perspective that if you look at the Indian banking industry right now, a lot of the funding growth is going towards already existing formal segments of the customer. So if you continue to churn or compete in a similar market and a customer segment, there is a pricing pressure. But if you think about all the avenues that the open stack, the digital infrastructure, all of that open up, you can start bringing into the formal space a set of customers that were not actually in the formal lending space. The yields will be better over there. Even with the credit cost, the ROAs will be better for banks if we start looking at that segment. And if you think about it in some sense, the MFI segment is a prime example of what this is done to banking industry. A lot of the banks are actually looking to bump up their ROA by going into MFI industry, by looking at gold loans as a segment. So yes, the digital infrastructure will start opening up the yield side more. The cost of liabilities will be tight in the next coming quarters as well, and that is a reality that many bankers are facing.
Yeah, I have one more that is with reference to increase of the digital banking and all that one. As you rightly said, a lot of retail lending is going, and already banks have captured the growth of on the retail lending for the last couple of quarters. They have been doing very well on retail lending. But is it in general increasing the individual leverage in the financial system, and which is going to be a very serious concern for policy as well as financial stability point of view. Not much of the growth is seen on the corporate lending side, but larger growth is more on the individual side. So this is retail lend side. This may be going to have higher individual leverage. What is your take on that? Whether RBI already has increased the risk weights to the retail lending. So uh, overall, how it is going to be affected? Because one of the things in the financial crisis was individual leverage was very high.
Yeah.
US financial crisis of 2008 and 9, the lessons is individual leverage was very high. Yes.
Yeah. So let me de-average that, and Deep, you can add to that. So if you look at the growth on the asset side, you're absolutely right. The private capex or the corporate lending is actually subdued. We've been talking about it for 4 or 5 quarters that the corporate cycle will come back, but it hasn't come back with the same expectation. So I think the bulk of the growth right now is happening in 3 segments. If I were to break it, right, there is the retail, which is not consumption oriented but asset oriented, whether it's mortgage, auto, etc. There is the second one, which is retail, lending, which is more consumption oriented, where a bulk of the initiatives by the regulator has come in place in the recent past. And then the third one is the MSME space. I think the MSME space is equally becoming a big growth driver for banks. And now if we de-average this, I think MSME, if I go first, is a segment that has traditionally seen a very high, NPA or delinquency rate. But with all the formalization that's happening, both on the payment side, on the GST side, and all the initiatives on the KYC side, I think that segment is starting to see much lower delinquencies and much lower, stress. So that's a growth engine that banks are now starting to look at as a profitable business segment. On the first part, which is the asset link, the mortgages and the pure retail segment continues to grow at a steady state. That continues to see a very healthy delinquency or stress rate. I think the middle bucket, which is the more consumption oriented, there are 2 trends that we're playing out, and as part of the report we looked at it. Number one is that the approval rates are getting tightened at the subprime, segments. I think the prime segment, the near prime segment are still continuing to hold. And what has happened because of that is the 1 year lag delinquencies that we've looked at is actually better than pre-COVID levels as well on the retail consumption side. There is loan stacking happening, over leverage happening. If we look at the single segment of the less than 50,000 bucket of customers, where there's a lot of fintech play, a lot of over leveraging happening, so that loan stacking is happening in that segment, and that's the one that most banks are cautious about. I think fintechs and NBFCs are much more aggressive in that segment, but banks are by and large quite cautious on that segment. While the narrative of loan stacking and leveraging is happening, that narrative is restricted to a very small segment of the overall asset pool of the industry.
Okay, I think let us see that the balance will be there between the corporate and MSME lending and retail lending, and which will not have a much stress on the individual side as well as the bank's balance sheet side. Finally, just before I hand over to Professor Dr. Gupta, one more thing. Your thoughts on green banking is extremely good, and climate risk and green finance is climate finance is very much important. All these things, but the point is whether regulator is going to impose any type of the climate risk premium on the loans or capital adequacy side when they are emphasizing on these things, or there will be some incentives to promote this one, whether it will be on the positive side or negative side. What is your view on this?
So on the green side, I think there is a certain reality that the national pathway has to look forward, given that we are still a developing economy. There are needs in terms of energy consumption, etc. I think our view is that irrespective of the regulations, there is a certain need for banks to at least start looking at this capability more holistically. And if we just take a simple, example of the number of, relationship managers in banks that are actually serving MSMEs and corporate, we leave us retail as right. Just the upskilling of these, relationship managers to understand green financing, to understand the impact of physical risk, transition risk, and then educate the borrowers. I think that itself is a very, very long journey and a difficult journey that banks need to undertake. So our view is that there are a certain set of steps that banks need to undertake irrespective of the regulatory action. Because once the regulatory action comes, then it's a scramble to, get this done in some way or the other. Right now, there is, a certain window that banks have to actually take a, pioneering step rather than wait for regulatory action. So our view is that there is certainly a set of things that are no regret moves that banks can certainly start forward right away. There is a certain set of things that will have to come only through regulation. We'll have to wait and watch how the regulation evolves in that space, sir.
Very nice. Thanks, Hardik. I give it to Dr. Gupta, and Dr. Gupta maybe now can.
Thank you so much, sir. Excellent presentation, very insightful by the BCG team. My compliments. Just one or two quick thoughts on the presentation part and the concepts used there. A bank typically in the capital structure may also have an amount of debt. So they're going to have a proportion of certain amount of equity and certain amount of debt. When you look at economic profit, it is only the return on equity in excess of the cost of the equity. Would it not perhaps be more appropriate or an alternate way to look at profitability of the banks or the value of the banks if you look at the economic value added, EVA? Because EVA looks at return on capital employed minus WACC. So it takes into account all the components of the capital structure, and probably for at least some of the banks which are highly leveraged, that might perhaps be a better performance measure in terms of, assessing the performance of a bank going forward. Your views on that?
Yeah, maybe I'll take that question. So, sir, totally aligned with you. So, the simple connect. So, what we are calling as economic profit is the return, pure
Yes.
percentage return metrics. When I sort of change it into a rupee value using the capital employed, you would get the EVA. So someone with EP positive will have EVA positive. Now, the quantum will be driven by the capital employed or ROIC. Now, there are certain flavors, just like one can have a cash flows to firm vis-a-vis cash flow to equity type of assessment. You can have a overall capital employed. So this one can be enhanced. We were just focusing on equity, but the math is in some sense linear and deterministic. So you are very, very unlikely to have someone who's EP positive having EVA. It will not be negative. The rank ordering makes that change based on the exact leverage.
Thank you. Secondly, we are living in very, very changing times, and there are changings happening all across around the world in all aspects, all dimensions, including corporates and the banking and the financial space. And people are not actually looking for profitability or returns in that sense. They're actually looking at the ability of the banks or financial institutions to be able to create value for the stakeholders, preserve that value over a period of time, and also enhance that value going forward on a sustainable basis. So what, according to you, are one or two key levers for value creation for the banks in these changing times?
So absolutely rightly put, and that's why the central theme of our report is that we are living at the best of profitable times if you look at the banking industry, right? There is a certain normalization that will come in place. I think rather than aspire to think about ways to maximize from this point onwards, there are capabilities that we need to invest and create as a banking industry. I think if I just look at two different parts and our views also, so one is, as we just articulated in the presentation also, there are a set of things that banks need to internally look at, and individual banks need to start looking at this, right? Whether it's distribution network, whether it's adoption of new technologies, etc.
Right.
I think one other view is also looking at an industry level utility platforms And by that, what I mean is that if we look at NPCI, it's a great example of how the banking industry has come together, created a utility that works for the banks, works for the customers, which is very different from, if you look at the advanced markets where there are monopolies, duopolies, on this space. And there are 2 or 3 examples that we can think about, right? Can we create a cyber risk utility for the banks to work together, right? Banks come together, pool in the information, create the right capabilities so that, real-time information is shared between banks in terms of cyber attacks, in terms of, incident management, etc. Similarly, climate is a big, agenda. Can we create a bureau-like structure on climate risk management, where there is India level taxonomy created, where there is India level research in terms of what are the emission norms for different types of technologies and different types of industries. Banks don't need to create this taxonomy individually one by one, right? And some of the larger banks will be able to do it, some of the smaller banks will not be able to do that. So it's also at an industry level, can we think about creating this utility platforms when the time is right, when we're living in the best of profitability metrics, and create these capabilities that will help us 5, 10, 20 years out. Bureau is a great example. The credit bureaus are a great example. They originated 15, 20 years ago. We're talking today, thinking about how great that they have been in terms of, enabling retail lending in a very safe and efficient manner. Similarly, a climate bureau created today, can it help us for the next 10, 15, 20 years and create a model that is looked upon by the world as a, really best-in-class model?
Sure. So just a last observation.
A couple of added points that, so those are the new challenges. There are certain things that were need to possibly change in terms of board and governance behavior also. Say, for instance, one of the things is a risk appetite statement, which all banks have it, and it should have been used in strategy planning and formulation. It rarely gets used in that sense. It's like something that's de jure, not de facto. The risk appetite statement design is also very, very qualitative. It doesn't sort of cascade into business unit level. So the strategic planning needs to be way more sharper. B, banks, despite having huge amount of data, other than a few banks, they need to invest heavily in data analytics and relevant processes to get those insights, which I think banks are aware of, but they're not possibly focusing as much as they should. As highlighted in the report that was published in FIBAC, barely 10% of Indian banks are what one would call analytically mature. Another way of looking at it is half of them are quite nascent in their analytical ability. So these are value unlocks which will help them in doing some of the things that Hardik has been pointing out.
Sure, if I may just add to the governance views and the governance point which Deep mentioned, banks should also look at having a committee, a board committee on ESG specifically, even though it's not mandated under company that or by the SEBI regulations as of now. But many companies in the corporate sector, in the non-financial space, already have constituted a board committee specifically looking at ESG. And going further up, one board meeting every year focusing only on the ESG as an agenda. No other agenda item, but only ESG, because that's what is actually going to drive the value all across all sectors, including banks, going forward in this corporate world.
Yeah.
Well, I'm reminded of the statement made by Bill Gates in 1994 when he said, banking is necessary, but banks are not. I mean, this is truer than ever before, Today, the customers' needs, their behavior, their expectations are changing. Banking is no longer a place where you go. Banking is what you do. And if you're provided convenience of doing that with your laptop, with your mobile, sitting at your home kind of thing, the customers will be truly having a very, very friendly experience from the banking space. So thank you very much, both Hardik and Deep, for your views. That's where I conclude my observations and views. Thank you.
Thank you, sir.
Yeah, we have one question from Dr. Charan Singh that is in the context of this discussion. Is there any distinction between public and private sector banks with reference to preparedness for the climate finance, transition towards the climate finance? Question is interesting, and I'm sure he knows part of the answer also, but still in the interest of the public, Dr. Charan have raised this question. Yes?
Yeah. So I think two, three nuances to that, right? You're absolutely right. There is a certain level of preparedness that's, different across banks. And if I just break that down again into two parts, the ones that are regulatory driven, which is, the emissions, the statement for, climate strategy, etc. That's a slightly different one, and that's out there in the public domain. But I think internally, when we speak to banks on the non-regulatory aspects of it, I think some private sector banks are starting to think about how do they at least measure the risks of physical calamities, physical vulnerabilities in the finance portfolio, even though it doesn't merit right now an increase or creating a climate finance premium or a tenor on the pricing, but at least start measuring this internally. I think some of the smaller public sector banks are still way behind the curve when we think about this, and just the conversation, as Dr. Gupta pointed out, conversation at the board level, at the management level is very limited on this front. So there is a slight difference between the private and the public sector banks, but overall, I think across the banking industry there is a very, very large gap to where they should start talking about this and adopting these practices versus where they are today.
Yeah. And a general point is, I think, the capability and the vision difference between banks is possibly lesser today on private and public sector banks, because the large public sector banks are for every conceivable purpose in terms of vision, capability, execution, are comparable to the large private sector banks. It's possibly between the difference is agnostic of private and public between larger banks and smaller banks.
Yeah, you are right, very much. Not all private banks are private banks. They are some legacy issues are there, and also having the issues relating to governance and capital and all these things. Whereas a couple of private banks are much ahead with the technology and all other foundational strengths required. So certainly there would be a difference between these banks in catching up with reference to the challenges of green finance or climate finance. What Mr. Anand is asking is whether organizers can give an opportunity, unmute him, and so that he can raise the question if he wants to ask orally. Yeah, Anand, please, quickly.
Sir, thank you very much for given the chance. Am I audible to the speakers?
Yeah, you are audible. You are audible. Please.
Fine, thank you. I must congratulate and compliment that the report is really insightful of the current scenario of the banking. As the banking is a very, very dynamic, space. So the mind is inquisitive to know that profitability which we are comparing. This is just the profitability, post the COVID. And COVID asked for certain assets to be restructured and the, some norms to be changed during that course. So is there any extraordinary impact of those regulations on the current profitability? One. Second is, this is now the net profit based ratios which have gone up may not be the only outcome of the reduction in provisioning which has come latest. So we would be, very much benefited if the group has taken an insight on the operating profit, number one. And the second question is, like when the interest rate scenario now turns to say southward, the lag effect then on the banking, maybe immediate reduction into the incomes, and the lag impact goes on the cost, which is positive now may turn negative in terms of the lagged impact. So these two pieces which are floating, how do we stand to withstand all these risks?
So maybe I'll take a step first. The interest rate movement impact on banks' balance sheet is always very tricky. One is the pure income, which is generated from the assets. But we should also appreciate that if you discount the sum of the largest private sector bank, a huge number of banks actually have significant treasury income. And treasury income actually moves the other way around.
Right.
Right. So how the exact systemic impact would depend on the treasury exposure, etc., etc. I mean, just take an example of SLR. It's below mandated is below 20%, but most of the banks have SLR well above 20%. Right.
Yeah.
So one would have to sort of look at the exact impact. It's difficult to say the nature of it. I mean, that would be.
Deep, if I can give you a piece of thought on this topic only, that the main operating profit of the banking comes from the interest income, and this other incomes from the trading of the, or the say depreciations, etc. They come in a lesser number from the non-interest side, so other incomes. So I'm more bothered about the interest income scenario, which is a major piece of the operating profit.
Yeah. So again, humbly, sir, there are banks where this interest treasury income is actually 30-40%. There are banks which is less than 20%.
Yeah.
This is a fact. This is a fact. I mean, so now, if I just look at the lending related interest income, yes, if it falls, what we typically see when interest rises, the banks tend to globally transfer the price rise to the customers immediately. When it falls, there is stickiness.
Correct.
So the transmission is not very linear and very timely.
Right.
I mean, one is the pure sort of narrative which we sort of see in textbooks. Other is pulling up the data and you see by the time the potential benefit of interest rates starts showing up one way or the other, something kicks in. So if someone does a causal inferencing based testing, you are unlikely to sort of come up with and attribute a specific reason. That's my limited point here, sir.
Okay. Right. Thank you.
Yes. Yeah, Mr. Chairman. Hello, am I audible?
Yes, sir.
Yes, sir.
Yeah, may I ask one question?
Yeah. Mr. Ashok, please.
Yeah, I find I must congratulate BCG team. It was a masterful exposition and it was very interesting. BOA. I was listening with the rapt attention. One small thing, the foundation stones of any structure are less visible, but the edifice of the system and the structure rest on it, and they get the value. They owe its elegance to those foundation stone. But at the same time, you have forgotten the foundation stone of the banking structure, and that is the agriculture. You talked about the MSME, you talked about the other thing, the corporate, but agriculture. To me, I think that is perhaps not the, because agriculture, according to the World Bank, a growth of 1% in agriculture is equivalent to 2 to 3% growth in non-agriculture sector. But at the same time, agriculture entails its own risk of recovery and other issues which are well known. So is it a conscious policy to for the private sector banks in particular, and the loan waiver and so many issue you have excluded, has it happened consciously or is by design? I just wanted your view, because in the economy, and let me also give one small example. In the COVID, that was the only sector which registered positive growth, all said and done. So our Indian agriculture is resilient, and therefore we can't afford to ignore. And to my mind, when we are talking of the 30 trillion economy by 2047, agriculture is going to play very, very vital role. So your comments and view on this.
So that's a very apt observation. There was no specific reason to exclude agriculture, but you're absolutely right. If we look at the banking industry and the exposure to agriculture also, there is of course a large part, as you rightly mentioned, is exposed to loan waivers, the challenges in terms of marginal farming, etc. But I think over time we've also seen a very, very large material transition for private sector as well as public sector banks towards high value investment credit, agri financing, and there's a lot of technology that's also going behind agri financing. In fact, some of the largest banks have tied up with multiple satellite, data providers to look at agri financing completely differently. So you're absolutely right. Your observation is spot on. There was no reason to exclude agri financing, but the next time we'll certainly cover this in the report.
Okay, thank you very much. Thanks indeed. I loved your presentation, both, and all three speakers spoke absolutely, and the chairman's observation and my colleague Charan, everybody. It was a sheer delight to listen to you from your perspective.
Thanks to all. Thanks to the team, BCG team, as well as Professor Charan Singh and participants, very active participation.
Thank you, sir. Thank
I
you.
think let us conclude, Dr. Gupta. And
Thank you, sir.
yeah, Professor Charan Singh has given good freedom for us to choose the lunch, whatever of our choice. So he has not a physical seminar. Had it been a physical seminar, we have to follow whatever is offered by EGROW.
Yeah.
So we have a lot of freedom. Thanks to all. And
Thank you.
is that okay?
Yeah. I'll just make a brief announcement in-house. I want to first thank Professor Jayadev for accepting our invite to chair the session. And of course, I want to thank both Hardik and Deep for presenting your excellent report with all of us, and want to thank Dr. Gupta for accepting to be a discussant. Thanks to all of you. Want to thank all the participants. This presentation will be available on our website by noon tomorrow. Please feel free to tap on it and share with as many people as you want, because it has lots of policy implications. I will also be doing the same. Next week in the evening from 4 to 5, we have professor from Nepal. She is Dr. Aruna Palike. She is presenting the Nepal agriculture scenario before all of us. Dr. Ashok Vishandas, our founder director at EGROW, will be chairing that session. So I would like to invite all of you to please participate in that session.
Yes, sir.
The last announcement I want to make is EGROW Foundation is making an attempt at, we all have heard about financial literacy. We are making an attempt at economic literacy. The advantage that we have, the online advantage that we have, we are trying to reach out to the masses across the country, especially students of economics, to hear and share their thoughts with the best minds of our country. So every evening, 7:30 to 8:30 p.m., under some module or the other, at a very nominal rate, which can be waived if somebody is serious, and otherwise we find that there's lack of seriousness, at a very nominal rate, we offer classes from 7:30 to 8:30 p.m. every evening. We would request you to advise students and practitioners of economics across the country to take advantage. The people who speak with us are senior people who have either retired or senior working as chief economist or working in different institutions at senior level, who have volunteered to come and speak and share their experiences with practitioners across the country. With those announcements, once again, thanking all of you to be here with us. We have experimented for the first time at a lunchtime, and I think it's been pretty good. Thank you very much.
Thank you, sir.
Thanks a lot for including this. Thank you.
Thank you.